off to, I forget, to Melinda, I think is the moderator. And so 15 minutes, it starts then. You have to be present that entire time. We'll do 4 polling questions. You don't have to get them right. You just have to answer at least 3 of them to prove that you were alive and breathing and at least paying some semblance of attention. The CPE will be issued in 7 to 10 days. Should we have to cancel the program because of any technical issue, even if it's at 47 minutes, there will be no CPE awarded, and you can yell, scream, and cry, and there ain't nothing I can do about it. So that's it. I'd like to introduce Melinda Lawrence, my good friend and great committee member who will be moderating tonight's panel. Melinda?
Great. Well, I'm going to do a quick introduction of the panelists. I'm not going to read too much about their backgrounds and bios. You'll get a flavor for where their expertise is as we go through the panel, but just a little bit to let you know who these smiling faces are behind these pictures. Well, first off, you'll notice when Finley talks, he looks just a little bit different than he does in this photo. His COVID beard is shining through, much like many of you guys did. So he's a partner with Moss Adams in their consulting group, and he has over 20 years of internal audit implementation and public accounting experience. And he specializes in Sarbanes-Oxley consulting, internal audits, and controls-based consulting. So he's your expert when it comes to SOX implementations, including risk assessment documentation and internal controls testing, as well as anything public company reporting. So go to him for those things, and you'll see that those tidbits as we talk through it. But the fun thing is pre-COVID, I guess this was pre-beard as well. He and his 14-year-old son bought matching 1980 BMWs to repair during COVID as his son prepares to become a driver. So good luck with that. Then next up, we have Chris Babcock, who is a partner with Foley and Lardner. And surprisingly, he does not have any Baylor Bear paraphernalia behind him because he is a proud alum of Baylor and being a national championship team in basketball. So I think we already all talked about that, but that's exciting. And then thank you, Chris. He served in the United States Air Force. So thank you, Chris, for your service. But his day job isn't around being a Baylor grad or an Air Force alum, but he focuses on private equity and corporate governance and security matters. He's on the firm's private equity leadership team, and he has significant experience representing private equity funds and their portfolio companies with focus on mergers and acquisitions and portfolio company governance, as well as representing public companies and private companies in those types of matters. He's also written lots of articles. So you could probably Google search him and find his name on some really nice articles showing his knowledge in all things corporate governance. So that's where we're going to see his expertise come out. And wrapping up is Zane Terrence, who is with Founders Advisors. He leads the technology practice for them. And they really focus on the middle market. So a lot of us, I think, will relate to them. And he's an experienced investment banker, entrepreneur, and recognized expert on the growth and monetization of digital media, internet technology, and software companies. And before that, he successfully created and sold 2 technology businesses to publicly traded companies. So I think he knows what is needed to build a valuable company and close an exceptional deal. And on top of that, he is a published author. He has a book he published called 17 Reasons Your Company is Not Investment Grade and What to Do About It. And last time I checked on Amazon, it's a 5-star book. So go check it out. So that's enough about our esteemed panelists. I'm going to go ahead and get us going here. For questions, feel free to message any of us or message me directly or just put it into the chat. So feel free to ask along the way. We don't have to hold all questions to the end. But I'm going to start off with Chris. What exactly is a SPAC? Who sets it up and why is it so popular right now?
Sure. Well, thank you so much for that introduction. A SPAC, very simply, is a blank check company, special purpose acquisition company. These are vehicles that are formed. A sponsor, a financial type of some sort, will have an idea, have an investment thesis, form the company, take it public, and then go and search for a company to acquire. These companies take advantage of the fact that it can be relatively easier to get through the public registration process as a blank check company. There are requirements they can meet. There's a path they can take. And then they seek a target entity with the idea that they can sort of fast track the process. And we'll discuss a lot of the nuts and bolts of that throughout the evening. But they basically provide sort of a dual thesis, if you would, to their investors. SPACs tend to provide a relatively stable investment. You typically invest a unit of a SPAC. The price is usually going to be $10. That will include one $10 share and one warrant in case the shares go up above $11.50. And there are several opportunities to redeem that share if the SPAC ultimately is not successful in acquiring a business, or if the SPAC acquires a business that you as the investor don't believe is going to be worthwhile. The benefit is you've now got a warrant, you've got some upside, you've got in on the early levels, and so you've achieved a better return than if you had waited until the company is acquired, taken public, and invest after the fact. For the target companies, SPACs provide a clear path public. They tend to be a little quicker than going through the IPO process by yourself. Although you're still going public, there's still a lot of work to do it. It's not it's a simplified but not a simple process. And they provide a little more pricing and other certainty up front. So if you've got a company that is looking to go public for whatever reason, you think that's the right exit for your investors, you think accessing the public markets will be a better source of capital for you than your current financial sources, you think it's going to be important to develop and to execute on your long-term growth plan, then you might look at a SPAC, and they're going to be able to promise you, not promise, but they'll tell you that it's a promise, but they'll be able to convince to you that they've got a pretty good price locked in. They'll talk to their early stage investors, have a good fixed valuation early in the process, so that you'll negotiate a deal, get a valuation for your company, have a path relatively quickly to going public, without going through a much longer process that often involves pricing at the very end and creates a lot more uncertainty. Sounds great. What's the downside? As we'll discuss a bit, SPACs can be very expensive. Their financial sponsors and other early investors typically have a significant number of rights and discounted shares that can give them a significant stake in the company at a relatively low price, which is going to increase the dilution that you are going to experience going public than you might have through a traditional IPO. SPACs are something that we've seen become incredibly popular over the past 2 years. They've been around for a while, but they've really had a significant growth. And I think that's a confluence of several factors. The first is that you've got a lot of investor excitement in the public markets. The number of publicly traded companies has gone down as private equity gets more sophisticated, as institutional investors play a larger role in the landscape. I believe pre-COVID, there's about 1.5 trillion, give or take, of private equity dry powder in the market. And so a lot of companies that may have gone public in earlier decades have gone to private hands. And what that means is there's significant investor demand for more publicly available, publicly traded securities to raise. And I think the other thing that's really happened, that's really seen growth in SPACs, is you've had a lot more comfort with companies going public in the very early stages. I think you started to see that with the quote unquote tech unicorns, when people were willing to have an IPO for pre-revenue companies and showed that the public markets could understand it, but only understand it to a point. This showed a lot of demand for companies maybe earlier in their life cycle than they would normally think about going public, but it created an opportunity for these SPACs to come along, say, here's an investment you can understand. You're getting in on maybe not the ground floor, but an early floor of a growing company. It creates a lot of opportunity in the marketplace.
Okay, thank you for that overview. So you mentioned a couple of things. So in there with some of the different players. You talked about sponsors and targets. So Finley, can you tell us maybe who's involved in setting up a SPAC and what their roles are?
Yeah, certainly. The two simplest ways to describe it is you got the sponsor, which ultimately is a group of investors that's going to start what Chris referred to as a blank check company. SPAC is short for Special Purpose Acquisition Company. That's the acronym there. But as part of that is you've got the sponsor who actually sets it up and actually takes that company public. And it's a non-operating company, so it's just a shell. There's no operations there, and that's a critical distinction there versus a reverse merger and some other ways that companies can go public. But so for a SPAC specifically, it's a blank check company. So it's just a public company shell. And that really is then the vehicle that the sponsor would actually go seek a target and actually buy a private company and take them public. So effectively what happens is a reverse merger of sorts through that public company shell. And so ultimately the SPAC then buys or acquires the target. And then from that, then ultimately that target becomes the successor public company. And so as we think about that, those are the two main parties. So you'll hear sponsor or the SPAC synonymously used. And then you'll hear target company, and that's the company that ultimately is the private company that's going to be taken public. One of the things that's really interesting, and I think from our perspective here at Moss Adams and working with a lot of companies going through this, making the decision, how do we go public? What does it look like? The board's got some fervor excitement around SPACs. They're seeing what valuations are looking like for peer companies. One of those important distinctions is as a SPAC, and I think Christopher said it really, really well, is it's simplified, but it's not simple, is when you think about going through a SPAC, and if you're a target company going to be acquired by a SPAC, it's all the pain of going public, or most of the pain of going public. It's most of the pain of going through an M&A deal, and most of the pain of going through a financing all kind of concurrently. So as part of that is you really have three elements going through, because many times through that SPAC, they'll also have a pipe right in the middle of that as well. So again, we won't go into all the details on how the economics work and the dollars flow out. But as part of that is ultimately you've got the sponsor that's going to acquire the target, and the target is going to have to be a public company in a very, very short amount of time. And I think as we think about, and Chris mentioned this, is SPACs have been around for a long time. Burger King, as an example, went public through a SPAC. So this is not a new thing. But what it used to be, and I think, at least for us here in Moss Adams, SPAC almost used to be a four-letter word. Obviously it still is, but used to be almost a four-letter word. For us to get that through client acceptance was always a challenge. And I think really a key piece, and for all of you, and if you look at these, there's been a huge shift, and Chris mentioned that, there's been a huge shift in how the market really perceives companies going public through a SPAC. And so over the last 24 months or so, it's a huge shift towards the positive in terms of companies going public through a SPAC, whereas again, before it used to almost be a four-letter word or kind of a dirty concept that you'd sneak on to a public exchange. And really that's changed, and it's really a lot of companies are going public through that vehicle right now.
Okay, well, thank you. And so on that note, it sounds like there's so much going on with SPACs. There's roughly 200 SPACs currently looking to acquire a company. And then, as I mentioned, there's a deadline on having to acquire a company. So Zane, can you address what that looks like for potential targets and investors?
Yeah, that's a super question, Melinda. And one thing I want to say, I think Chris and Finley did a super job about, what a SPAC is and why. Being an investment banker, I probably have a perspective that might be a bit negative. I love SPACs, but there's still some issues. And one of the things that both of them alluded to, and I appreciate this, is that they're supposed to be simpler than an IPO, maybe not a direct listing, but simple. And a lot of people are touting them as inexpensive. I want to submit to you as somebody that makes money as an advisor. I like it. We like SPACs. There's a lot of money involved in that, in the pipe and the SPAC. So just a little bit of a side of these, of what's going on in the market. And as far as potential targets and investors, Melinda, I see that there's a tremendous amount of competition for strong targets. Because you've got a lot of people chasing these targets, right? Private equity, as Chris said, there's so much dry powder right now in private equity. There is on balance sheets right now on large corporate companies, publicly traded companies, the cash on the balance sheet is some of the the largest it's ever been. And so you've got a lot of people competing for these go public ready type companies. And as Finley said, I mean, you've got to be ready to be public. And we're going to talk about the preparation and what that means. So I personally believe that the targets are in the driver's seat here. I believe the SPACs that are out there that are continually looking, they have 24 months. Sometimes you can extend that time to find a deal. I think the targets are in the driver's seat. The other thing I would say, though, a lot of targets, people that think they're targets are not. There have been, a few cases where early stage companies have gone into a SPAC, but I'll tell you, I talk to SPACs a lot, and they are typically looking for a very mature company. And so for that sake, stance, I would say still the great target companies have all the options in the world. And unless those sponsored SPACs are an unbelievable management team that's going to add a lot of value, not just a celebrity, a past sports figure or actor, I think it's going to be thin picking over the next 12 months for these SPACs.
So
Zane,
they look, oh, go ahead.
Zane, I just wanted to share something, as we think about the ramp, and there's great charts out there that you all can Google, but in terms of how many companies have gone public, just the SPACs, how many SPACs have been formed. But as Zane just mentioned, a lot of them they'll all have a defined clock on when they actually have to consummate the deal, when they have to close that. A lot of them have that 24-month, some are 18, some are even 12. But as part of that is I saw just a couple of weeks ago, there was one day where 10 SPACs went public in one day. So that's new SPACs being formed, not where they had acquired a company, but 10 went public in a day when I looked at the SEC or Edgar on the SEC site. And so again, there's a lot of SPACs out there. I think Zane's totally right on. When I'm working with clients right now, they're talking to 2, 3, 4, 5, 6 SPACs. And many times getting an LOI from a couple of those. They may have actually talked with 20 SPACs kind of in prep for all that. But I would say, I love what Zane said, is it's not always simpler, and it's not always cheaper. It's not always quicker either. So again, those are a couple just quick takeaways as we think about what this looks like. And it feels like kind of the .com craze redone here in SPACs. And he's right. There's celebrities that have them. There's rappers that now have a rap song about SPACs. I didn't know that was possible, but it is. I saw it in the Wall Street Journal. It must be true. All of those fun things as we think about kind of what this brave new world looks like. Melinda?
Well, you guys there's been some great questions that I think fit in right here. So Finley, what you were talking about is, do SPACs have to have target companies identified before they go IPO? Or what have you seen? Maybe it's not a requirement, but it's a really good idea. What have you guys seen in practice?
Well, actually on that one, and then I'll let Chris speak to the legal pieces. It's actually illegal for them to have a target in mind. So they cannot be created with that target in mind. So what they will do is when they actually get formed, they'll say how many months to do the deal, to actually close that, or what's called the consummation date, which actually would be closing of that acquisition of the target. So to have that, many times it speaks towards a industry, a subsector, a geography, an unmet need, et cetera. And so there is, as ultimately as the SPAC goes public itself, when they're targeting investors and filling the book, they're going to give a story and paint a picture of what they're going to do. And so as we think about that, a lot of it's in electric vehicles as an example. A lot of it is in technology plays. A lot of it is in, it's actually interesting kind of food and ag right now. There's a lot of conversation around that. Certainly kind of disruptive players in that. So, if you think about somebody who delivers food to you instead of you going to the grocery store, a lot of those things. So again, they can't have that target in mind when they go public.
Hey, yeah, go ahead, Chris.
I was gonna say that's exactly right. Part of being a blank check company is they really are a blank company. And as Finley said, they'll have some industries they might focus on. They might tell their investors, hey, we think these are the disruptive industries and here's where we're going to focus on looking on our targets. But not only will they can't have a particular company identified. They can't say, you can't talk to someone who's thinking of forming a SPAC and saying, hey, we'd be a great target. Why don't you go through the SEC process and then you'll jump through and that'll save us. I mean, first off, you're doing 2 securities offerings when you could just do 1. But more importantly, you're at the risk of really violating the SPACs mandate and the SPACs regulatory frame. The other thing that's really worth knowing about SPACs, as you know, they're everywhere. And although I won't say in the age of GameStop, a rap song about SPACs surprises me, I think that says more to the era than it does to how unique it is. But I will say it's worth knowing with the SPACs as companies get approached by them and think about also their window of opportunity. If this is something they're going to look at, it's worth noting there, as with any new financial innovation, you're starting to see concerns rise. The SEC is starting to make a lot of comments and discussions that, hey, we are a little bit nervous on the effect of these on retail investors. And while that has not turned into regulation yet, it's not something I'd expect in the next month or tomorrow. Certainly, it wouldn't surprise me if sometime later in the year we start to see some additional guidance, maybe soft played in, to really make sure that SPACs, because right now, you've got sort of anything to get attention, and you want to make sure that, I think the SEC is concerned, although in the era of GameStop, I'm not sure why they're concerned, but they are concerned of people investing based on celebrity endorsements or known figures who are raising this and trying to monetize their celebrity through these vehicles.
Yeah, one other thing I wanted to add to that, and Chris, I think you're spot on this. We are seeing the most successful SPACs that are looking for targets. When I have clients that are talking to SPACs, the SPACs that really get my clients' ears are the ones that have been there, done that, executives in their segment. If they can speak the language of these owners, of this board of directors, that's exciting, because they know there's going to be, or hopefully, a lot more opportunity to add value once the company goes public, right? Because you have a team that is actually adding value. And what you're betting on as a retail investor with these SPACs, initially, you're betting on the management team. If they don't know how to go get a deal done, have the confidence to compete, because they're going to have to compete for these, get a deal done, do all the stuff you have to do that Finley and Chris will talk about to get sign off from your investors in the SPAC to actually consummate a deal. This thing's really risky. And I think retail investors that I've seen involved in this, they really don't understand truly what they're getting involved in. If you look at the performance of SPACs, once they go public, it's not that good. And the last thing I'll say, Melinda, on this, on the question you asked me, I think some of these sponsors, now this is a safe place, right? I can tell the truth. I'm the president of my broker dealer, so don't anybody, but I think some of these sponsors are overpaying for these targets because the herd is thinning out. Some of them don't really, they're not as astute as they should be. They are going to overpay for these targets, which has a tough effect on everybody involved.
Other than the targets, who are generally happy to get the extra
Chris,
premium, although the expenses usually mitigate against that.
Chris, and to that point, why have SPACs become so popular? Here I go again. I love private equity groups. I make my living with them. They love SPACs. They're having trouble with secondary buyouts when COVID came and all the issue with the economy. So they're the biggest proponent of SPACs because it gives them an exit where they can exit, get their internal rate of return, their hurdle rates for their LPs, get a whole new set of LPs with common stock, not preferred, that are retail investors. I think this is a very interesting, I think there's a lot of PR from private equity for SPAC craze.
So then, can SPACs acquire public companies? We've got a few more questions on this kind of intro area that I'd like to get us covered before we move on. And we have a lot to cover. So, but this is great. So can they acquire public companies?
I've never heard of that. I'm not a securities counsel. I've never heard of that, but I know that they're designed to buy private companies. In fact, actually, when you look towards some of the deals we've been working with, Is there maybe an NFP or not for profit piece where they've got to spin out part of the target into two different entities? But Chris, I'll defer to you on that. I'm no attorney, so I'll defer to Chris on this.
Yeah, I mean, I've never heard of that done, and I've never heard of it done. I'll say more fundamentally, a SPAC, you're going to have to look at the operating documents of the SPAC as what they define as a business combination. Every SPAC has a mandate. They have to acquire a company and take it public within a fixed time period, or else all of their investors have the right to redeem out their capital, get the $10 per unit they paid back. I can't think offhand of SEC guidance that necessarily prohibits it, although it may be out there. It's just, but you'd have to look at the terms of their own documents, the terms of their documents. The real truth of it, though, is there's no benefit to them acquiring a public company, because all they would do is really dilute there's really not an economic reason why a SPAC would take an already public company public. And it's hard for me to envision one.
Okay, that makes a lot of sense. And so then following on that is, can you bring multiple companies together? So can a SPAC go out and say, hey, we want to build this platform, so we're going to go make multiple acquisitions. So Finley's given us the thumbs up. Okay, so you could do that. And then so after hearing all this, one of the questions we got right at the beginning, is it easier to go public with a SPAC compared to an IPO? And I know we've got some other questions that will address that, but that was the first question out of the gate. So thoughts.
It's like I said, it is simpler, but not simple. And one thing now, if you ask me, well, you said simple, not easy. The reason I will qualify that distinction is, on the one hand, you've got a quicker, more streamlined process in a lot of respects. And you've got a SPAC who's been public, who at least knows some of the lifting involved, but you also have a very rapid period to get ready to go public. So if you're a company that was already ready to go public, you're thinking of an IPO, you got ready, decided the markets weren't right, and a SPAC comes along, it might be easier. If you're not a public company and you've never thought about going public, and you've never paid it, you don't even really have audited financials or something like that, there's a lot of work to be done. And the SPAC's compressed timeline can make that work incredibly difficult to do and to get right. And then you compound that with a management team who's not used to being a public company, a management team who's used to talking to private investors and able to have conversations, who now have to get used to the niceties of public company, Reg FD, the fact that you can't have a private conversation about material information. You've got to know what you've got to disclose, how you've got to disclose it. You have a lot of related party transactions, the number of private companies where you've got something really weird with the insider ownership, and not weird, I mean, not nefarious, not anything untoward, but maybe there's a loan between a company and an executive for a valid reason. Well, now that's going to be a problem for the company when it goes public. So you've got to work through a lot of these really complicated issues, and you've just signed an agreement that started a clock. It's going to be like any merger agreement with a staggered sign and close, where you're going to have certain deadlines by which you have to close it. And not only do you have deadlines within that agreement, the SPAC's got a deadline to close the transaction, not just get it signed up. And you've also, if you're used to raising capital on the private markets, you're not going to be able to raise that capital in the middle of this, right? So you've got to make sure you've managed your cash flows and other things appropriately. All of that can add a lot of burdens and complexity to the process. So to sort of go back to the answer, it's a very solid maybe. It is simpler. And if you're otherwise ready to go public, it may be easier. But if you've never thought about going public until you're approached by a SPAC who's hot to trot, you're going to have a very steep learning curve and very little time to do it.
Wow. So that sounds like a ringing endorsement to just jump right in. So Finley, were you going to add something?
Well, I was just going to say, I think Chris said it really well. SPAC is easier. The key challenge, though, is that companies that were not planning to go public are now taking the SPAC route to go public and doing so in an incredibly tight timeline. So I think that's the piece. And you think about this, the SPACs have to close the deal within a set amount of time. I was talking with one of my clients recently, got approached by a SPAC that went public earlier this year. They have 12 months. I mean, to just get a SPAC or get a deal done in 12 months, I don't know why they chose, some of the SPAC chose that, but they did 12 months, right? So if you think about that, the incredible pressure and the time window, likewise, and Zane said it well, it is a target's market, so to speak, on this. You know, SPACs are out there trying to hustle and go find good, viable candidates, and then vet them out and go through the diligence and drop them quickly if it doesn't check out. They've got to do that incredibly quickly. And so there's a lot of pressure on target companies if they weren't ready. And when I think about historically what I've done for the last 20 years of my career and helping companies go public, it was like, okay, let's have a couple year discussion towards going public. Years, not a year, but years to go public. Of like, okay, let's have real systems. Let's have a full team to do the work, right? So, people, process, system, do you have all that? And I think the challenge that we're seeing with so many of these SPACs is they have neither people, nor process, nor systems. And so I think that's one of those challenges that the SPAC or the target companies are going through. And many times, not to criticize, but the board members hearing, oh, there's a competitor, they got this amazing valuation, which we'd have to actually work through what the math looks like, and Zane can draw that out for you later. But as part of that amazing valuation, we've got to go. We're going to go through SPAC. We're going to go ASAP. And so I think that's one of those things that's really challenging, is that these SPACs just aren't ready. And so yes, easier, not always faster, by the way, but yes, easier, but only if they were ready to go from the get-go. I do see a question in here: is do SPACs have to do 2 or 3 years of financial statements? Depends if they're an emerging growth company or EGC. And so those things mirror over with an S1. There is a couple caveats depending on when the SPAC actually went public and if they filed their first 10K, but typically 2 years or 3, most commonly 2 if they qualify as an emerging growth company, sometimes 3 depending on their size if they don't qualify as a smaller reporting company under the requirements.
Yeah, so are we seeing, so this is not a question someone put up, but I think very close to what you're saying. So are we seeing companies who might not otherwise be a public company end up being a public company because of the SPAC? I think we've had conversations around this where you've got these small companies who are public and you scratch your head and go, why the heck are they a public company? Is that what we're seeing a little bit with some of the SPACs?
I think you can see it. Again, it's a process that gives a path that may not otherwise be available. And for some companies that might make sense, for others it may not. And it really does you have to have a lot of good, thoughtful decision as to whether you think you're ready to do this. But I think there certainly are times when a company is approached by a SPAC or interacts with a SPAC, the company wasn't really thinking about going public, and now they've been provided with an opportunity that is interesting. It's an opportunity for a lot of reasons. It may give an exit to some early shareholders. It may give, it may be an attractive source of funding. It may be the fact that, hey, there's something to being public. There's a benefit of having a public equity currency that the company may think it can capitalize on. There's a lot of decision points that come in, and there are a lot of companies who just aren't in a place where a traditional IPO is something that has really been, I'm not saying they wouldn't be able to do it, but it's not something that they would normally have considered. Well, now someone's raising the question. And so I don't think it's so much you're seeing companies who are just entirely unable to go public. I don't think it's that. I think it's, a lot of companies may not be at a place yet where they think they're ready to go to, they're interested or they're considering an IPO. And these SPACs that are desperate for deals, that are hungry to do something, see an opportunity, and they've got their clock ticking and sell them up and give a very attractive valuation. Well, now you've got a very interesting proposition, and it deserves some thought and consideration, even if ultimately your decision is, no, we're going to stay the course and either stay private or go public down the road on our own terms.
There's one particular situation I want to say, Melinda, I'll go very quick. And of course, Finley, does a lot of this in the IPO readiness practice he has. One of the things I see that I've seen in one particular case, a small little company probably pursued a SPAC and shouldn't have. It actually went through, and tech company, because that's all I do. What I found, they struggled so badly and it didn't go well. Weak budgeting and forecasting processes. Investors of a public company, you've got to have credible forward-looking statements. When you talk to your management and to the market, they didn't have the rigor and the accurate budget and forecasting processes to give the street and investors confidence that they could really drive this. Therefore, what happened to their stock? The volatility went nuts. So I would say, I think some of the hurry, get ready, the time's ticking has caused some companies to go way premature, personally.
I think that's
sorry, Chris,
exactly,
go ahead.
well, that's exactly right. And just one thing quickly, I'll say, if you're a company who hasn't thought about that and you're approached by a SPAC and they're telling you, hey, we got to move, we've got a deadline, and you need time to think through, it's worth looking at the SPAC's documents, because most of their deadlines to get a deal can be extended with a shareholder vote. Is it terrifying? Yes. You never want to go out and say, hey guys, would you like me to pay you right now? Or can I keep this money as a war chest? It's always nerve-wracking, but that's usually a possibility. And I think, Zane, you're exactly right. It's a decision that's a real significant decision for any company. And it's not one that you want to rush into just because your counterparty is really, really anxious. You want to make sure you've thought through all the implications.
So a lot of us are CFOs on this, so I'm going to skip around a little bit, but just thinking about getting started on this. So Zane, this is for you. We've heard all this and we're ready to go as a management team. The board's interested in going this SPAC route rather than IPO. We could talk a little bit about that, but what do they do? How do they actually find a SPAC that could acquire them as part of their exit?
Great question. Of course, I don't want to sell what those of us that do that are on this call, but advice, you can get any banker like me that's a specialist in your industry. They already know the SPACs in your segment. They know who they are. It's very well documented through CapIQ and PitchBook. And just if you're a banker and you're a specialist in your sector, you're going to know who these SPACs are. And what's happened, a lot of these SPACs are run by been there, done that management teams, as we talked about, that are already very well known in the industry. So I would encourage you, if you're a company that wants to look at this, get with somebody that understands this space, an advisor, for free. They will help you understand what does the landscape look like, who might be a really good fit for you, and at least have a few conversations, right? I don't think you ought to, rush into anything, but any advisor that works in this space will know the SPACs that could be the best fit for you based on their check size, how much money they raise, because I think, again, they have to spend 80% of the money that's in escrow. So that's what I would do to collapse timeframes. Talk to an advisor that works in your industry in this space.
So if you think about that, we had a question come up is, so ongoing, let's assume you have a SPAC, you get acquired by the SPAC. Who's the management team going forward? Is there 2 layers of management team, or what does that look like?
Yeah, go ahead, Chris.
It's negotiated in the deal. You're going to have the board of the new company, and part of your merger agreement or purchase agreement, or however your acquisition is structured, is going to say who becomes the board of the public company. And that approving that board, at least initially, is going to be part of the overall SPAC approval process, right? Because the final stage, once you've gotten through a deal, once you've got your registration statement filed, and once you've got your registration statement approved by the SEC, is the SPAC's going to have to take it to a shareholder vote, and the SPAC shareholders are going to approve or disapprove the deal. And at that point, they're going to approve the board that was agreed and part of the early negotiations. But that's who's going to control your company. That's who's going to be in charge of your company. Some SPACs, and this is part of the problem, some SPACs have a management team who they think is a value add, whether as an advisor on the board or whether they're looking to control the board. Other SPACs aren't going to have that, and they're going to rely on the target company's management to really take a lead. You'll probably have some oversight from the sponsor team, but it's going to vary dramatically based on the dynamics of that sponsor team, the target's existing governance, and candidly, the leverage the parties have in the transaction.
Zane, were you going to add anything? I know you wanted to.
No, I think that's right. We've typically seen that some of these SPACs that are really wise, they bet on the jockey more than they even do the horse. So they like the been there management team that has made this target company SPAC worthy. And so they give them enough options and an incentive to stay in place. But as Chris says, they're going to want board oversight. And a lot of times they will bring in, guess what role? CFO. CFO, because they do understand, you know, what a real CFO is. And a lot of these targets over title, they're financial people. They think CFO and they really have a controller. So I agree with Chris. The ones I've seen really meld, the SPACs are industry experts, but they come after this target worthy, fast growing, nice recurring revenue, all the wonderful things you're looking for, the great, you know, gross margin profile. They want the management team that made them SPAC worthy to stay.
Okay, thank you. And so on that note, we're talking about the SPAC gets formed, then they find a target, and then there's, it sounds like another registration statement that happens. And the allure of a SPAC is we'll do all the heavy lifting when it comes to the registration statement. I'm seeing some smirks and laughs. What really happens then once there is that identified target? And it looks like we've got one of our folks on the call who is actually maybe being targeted by a SPAC, which is super interesting. So what happens then? Now they find it, you know, Finley and Chris, you're saying this all the time, you know, what happens next? Who really does the heavy lifting?
Your management are the only people who can put together your MD&A. And so your auditor is the only one who can put together your audited financials. There's a lot of I believe the technical term is legal gobbledygook in SEC filings that either party's counsel can work through, but there are fundamental questions and the most important parts of the registration process and going forward are really something the target company's going to have to produce. A SPAC that's got a lot of internal resources, that's done this a dozen times, can maybe provide some guidance. They can, if you're a company that's never really had a PCAOB audit, they may have recommendations, they may have thoughts on that, but ultimately you, the target company, are going to have to produce your financials, which is a very significant part, obviously, of the registration. You're going to have to know your governance. You're going to have to know and be able to describe your business, your models, your revenues, what you've been doing for your time. I mean, a SPAC can give you a great shell. A SPAC can give you a beautiful form of S4, all the right headings, nicely formatted. They can give you some thoughts and comments on it, but they can't produce your own analysis and description of your company.
Yeah, and I might just expand just a little bit on that. Chris is spot on. You know, as we think about, you know, the process, and I think it's probably buried in your question, Melinda, from somebody here on the call, is kind of how does this work? Here's Finley's 2-minute answer. I'll try and keep it to 2 minutes. The shortest answer is, as a target, you need public company audited statements, at least 2 years, maybe 3. So just FYI. Then additionally, those financials go stale. That's the SEC's term. And the SEC rule, which is 135 days. So as an example, and I haven't done the math, but I'm within a day, May 14th of this year, your year end, so your 12/31/20 numbers will go stale. And you'd have to include a new quarter in any registration statement filed. So the short answer is you need 2, if not 3 years of public company audited statements. By the way, the trick there is also, if you have 2 years if you've never been audited, you need 2 years of audited statements. You also have to audit the opening balance sheet, which would be January, in this case, January of 19, opening balance sheet, plus all of 19 complete, plus all of 20. So just, I know I'm talking to CFOs here, so you guys get that, right? But, you know, opening balance sheet for 19 plus all of 20, all of 19, all of 20. Then you'd have to include quarterly information to the extent of when you actually file this registration. But ultimately getting public company audits, PCAOB audits. Many times, by the way, if your auditor did the audit under AICPA or the private company standards, they may have done some things that actually impair them from doing public company audits. It's happening around, it's happening everywhere on our, not just Moss Adams, but everywhere. The SEC and PCAOB actually changing some of the independence requirements. But as an example, if your public accounting firm actually drafted statements or prepared the tax provision, they may not be able to actually do your public company audit. So you might have to switch from your current auditor to another auditor. So just FYI, if you haven't started your audit for this year, you have plans to go public, hit pause, talk to your auditor about independence. Just, it's public service announcement there. And ultimately you go through the audits. And from there, what you'll do is actually, you'll include your section, and Chris said it really, really well, your section in the S4. The SPAC is actually required to actually file that because they're the public company, not you. But in that S4 is a section, and if you actually go to the SEC webpage, there's actually a sample template there. And Chris was talking about that. And SPAC's glad to give it to you because they're going to punch it over from the SEC website. And so as part of that, ultimately you'll have your financials in there, MD&A and business section, and then risk factors. The risk factors, somebody like Chris or counsel will write up, but that business section, which is a combination of kind of the MD&A, what the business looks like, in conjunction with the bankers to help distill that message and really get that message out to the street. Because ultimately this S4 is basically going to serve as the why should anybody actually, any of the current sponsors and investors in the SPAC actually buy or vote yes to acquire you. That's the important message right there. And that's that S4. Ultimately, later after that deal goes through, you'd actually have to do a Super 8K, which is even more expanded disclosures. And then from there, then you throw it, and then you throw the switch and you become public. So that's, I tried to do it quickly. I probably failed, but that's kind of a little bit about what that looks like just at a high level.
No, I think you bring up some great points of, if you are like most of us who are private company CFOs, we follow AICPA audits and independence, and that's a big thing. So that may be something we all just keep in our back of the mind. So that's some of the accounting housekeeping that we might think about. So Chris, what are some of the legal housekeeping items as we think about, potentially working for a company who's looking at going forward with a SPAC as their buyer?
Absolutely. So you need to look at your company the same way you would before an IPO. What does that mean? For some companies, this is going to be the easiest thing in the world. There's one share certificate. That's it. That's all they have, maybe some bank debt, and they're good to go. But you need to know your cap table. If you are a mature private company, if you've had several rounds of investment, if you've got multiple series of your stock, and maybe some warrants and maybe some convertible notes, and hopefully you are far past any safes or anything other super exotic structures, but you need to make sure you know who owns you, who has a right to make decisions for the company. Have you cleaned that up? Have you made sure everyone knows what they're going to get? You need to make sure you understand what your governance requires. Who can approve this transaction? What members? Do you have members with, look, this, again, for some of you, this is very easy. You're a basic corporation with a few shareholders and you've got a board of directors, 2 or 3 major investors. You talk to them, you get the approval. It's easy. Some of you may have more complicated ownership structures where you've just got a lot of people, where you're an LLC with a board with some rights and members of other rights, where you've got certain members with blocking rights who need to be addressed. Where you may have some notice requirements. You need to go through all of that very carefully to make sure you've identified it. I'll also say you should be aware going public puts a target on your back in some very real ways. And so if you have any ongoing disputes, especially disputes about equity, for example, a former member of management is no longer with the company and you're pretty sure you repurchased their options or their profits interest or whatever equity they have, but you really don't have that document on hand, you need to make sure you settle that, because you're probably going to have a higher valuation now at the time that you would have exercised those rights. You need to make sure you've cleaned that up and you know what you have going forward. What else you need to make sure you have legal? You need to make sure you are, you need to make sure you know you need to make sure you're past the point in a company's life where, and I have never heard this from anyone when they discuss it, I think the general legal response is la, 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 but you're not hand waving over any issues. because you're going to be under a lot of regulatory scrutiny. You're going to be under a lot of press scrutiny. There is a cottage industry of plaintiffs' attorneys who are going to look for things that you said wrong in a disclosure statement. There's a columnist I love. One of his recurring columns is everything is securities fraud. You're now going to be a public company. Everything you do, you're going to have to risk. Someone is going to claim that, and in addition to XYZ, you lied to investors. The other thing that you should make sure you know very well is what it takes to operate your company over the next 6 months to a year, because you're about to sign a transaction agreement. And this transaction agreement, unlike an agreement with a private company where maybe you sign and close at once, or maybe you're going ready to close once the antitrust statute clears in 30 days, you're going to live under this agreement for half a year or more. And so you need to look at the operating covenants, what it says you can and can't do, what it says about your ability to raise debt, to pay off debt, to issue equity, to pay bonuses. You need to know what you need to do, what out of the ordinary course activities you are going to take in the good case, the bad case, and the ugly case, and make sure that that's part of the terms of the deal.
Well, that's a lot of things to be thinking about getting ready. And as you know, Finley started, is a lot of companies go and they prepare themselves. You know, so I've been at private companies, PE backed, and as soon as I think it's very similar. As soon as the PE company makes the acquisition, you're already thinking about the exit. We got to be prepared for the exit. So we got to hit our numbers, get the systems in place, and tell that story. And so if you're trying to compress all that you've done in typically 24 months into a very short time period, and get all your corporate governance, that's a lot to put in place. So we are coming up towards the end of our time. There's a couple of questions that I would like for us to get answered. So I'm going to lob this last question to Finley, but Chris and Zane would love for you guys to jump in. And I think this is probably burning on a lot of people's minds. There's a lot of ways for companies to exit the business in a public way. So whether it's, you know, now the SPAC, the direct listing, the S1, and of course, we only have about 9 minutes left. So I know this may be hard for you guys to compress your answer, but thoughts on kind of the key takeaways that this audience should be thinking about as they're looking at this with their boards.
Yeah, perfect. Let me just summarize kind of the key options and what probably would be good candidates to go through each type. So there's the traditional IPO, which is the S1, S1 being the name of the registration statement. That's the most common one as you think about going public, right? So that's one that's been around for forever. Many of you have had experience in doing that, right? It's one that we all know and love, but at least know, right? So that's that. What part of that is that's going to require a longer timeline than SPACs. Also, as part of that is that also requires you to go on that roadshow and really go get investor interest. And I think that's an important distinction as you think about an S1. When you think about the next form is actually a direct listing. And what that is basically you're cutting the bankers out of an S1. And so from that perspective, you've got to have a lot of swagger and be really, really well known to be able to pull that off. And I don't say that lightly. And I think the role of the bankers in these deals is critically important. And what I've seen is that they're actually there to help companies through, not just clip coupons, collect a check, right? They're going to help refine and really vet companies in that process and help them prepare to go public. So as part of that direct listing, because it cuts the bankers out and says, hey, we're going to do that directly. It actually goes through an S1, just FYI. So those are the two most, or the first one, the S1 is the most common way. The direct listing is another form of that. Then you think about the other side of it. We just talked about SPACs. Certainly SPACs, and from that perspective is the sponsor is going to go rally and raise those dollars for you. As part of that, there could also be a pipe involved in the middle of this, right? Looking also at which of the who's going to stay in on the SPAC and who's not. And so that's part of that is they're going to try and push to keep people in. And again, you've got them working there. I think on the SPAC pieces, many times if companies had equal opportunity between the S1 and a SPAC, it really comes down to, where are they in terms of just readiness? And I think a lot of times it's people go down a SPAC path because they go, we don't have the time to go through a SPAC or through an S1. We don't have the et cetera, time, people, it's whatever it might be, because, and the SPAC's perceived as easier. One of the key distinctions on the SPAC is it is negotiated terms, so there's less market volatility. In terms of it is a negotiated deal, you know what that would look like. You can accept or reject that. What you don't know is who's going to come across from the SPAC. So people can actually take their money and go home, or take their ball and go home from the SPAC. So that's that SPAC piece. And then the last one would be a reverse merger. And so similar to a SPAC, what you'd actually do is you do a reverse merger into a public company, into a public operating company. So as an example, if there was a life sciences company, and this is a common example, there's a life sciences company where we're trying to bring, develop some new drugs. The science failed. They're sitting on a stack of cash from an IPO. They've got $150 million sitting on their balance sheet. They go, boy, our science failed. We don't have a plan B. They don't have a deep pipeline. What they might do is actually go acquire targets similar to a SPAC and then basically do that reverse merger. So again, very similar in terms of what that looks like. And again, those last two, both a SPAC and a reverse merger, are in fact actually forms of reverse merger. One's just through an operating company, meaning reverse merger. One's through a blank check company, meaning the SPAC. So as you think about that, they're kind of each unique in terms of what your ultimate needs are, what your readiness is. One of the things we haven't, I think we've shared some thoughts on SPACs, and even in prep, Chris, Zane, and I were talking about what this all looked like, kind of our views on some of these questions. But I think the SPAC's not for everybody, and so just got to go eyes wide open into that. SPAC's not for everybody. Going public's frankly not for everybody either. But each of these carries just a little bit of kind of a different view and different slant based on where you are, where the company is, what team you've assembled, and how ready you are to go. So I'll stop talking now, turn it over to Zane and Chris to see if they have any other comments.
Yeah, I think that's a great summary of the options to go public. I'll say the most important thing, if you're looking at a SPAC transaction, if you're looking at any sort of liquidity transaction, is why are you doing? And there are really two reasons to go for a transaction like this, unless you are just super thrilled to file a 10K and a 10Q and all your 8Ks. Unless you just dream of that, there are really two reasons to do it. One, to raise capital to deploy in the business, or two, to get liquidity to buy out some or all of your existing equity holders. And the question you should be asking is, why am I doing this? And what benefit am I receiving? Is this SPAC transaction really going to raise the capital I need, either directly through an infusion at closing, or indirectly through giving me a public company, and I expect my 10-year business plan involves several additional equity raises, and I think I am a better target for public investors than through raising through continued series? That's the question you have to answer. It's worth thinking of. We mentioned all the ways to go public. There are ways to stay private. As we mentioned, there's a lot of private equity capital that floats around, and that's something you should consider, because the most important thing to remember with a SPAC is an IPO. You are going public, and we cannot stress enough, both from a financial, from a legal, from all sorts of perspectives, going public and being an officer of a public company is very different from being an officer of a private company. Managing a public company is very different than managing a private company. And so before you're deciding between a SPAC or an IPO, you should think and make sure going public is ultimately the right way to raise capital or to provide liquidity or whatever your goal from the transaction is.
Well said. I'll do a 10-second, Melinda. Captain Obvious from Alabama. Great companies have all the options. Focus on being a platform company that has risk-adjusted future cash flow, and you can prove it in a great market, the great team, and then get professionals to help you know your options.
Well, this is great. I know we've got a couple unanswered questions, but I want to respect everyone's time because it is getting close to 6 o'clock. But this has been super valuable. I've got lots of notes. The one thing I'll take away is Chris's, why am I doing this? Sometimes I ask myself that daily. Maybe it's not related to if I'm going to go to a SPAC, but I think it's great information, a lot of good conversation. I really appreciate everyone's participation. I'm going to give a round of applause to our panelists, even though we're all virtual, and to the audience members. Thank you very much, and appreciate you guys participating in the polling questions And again, the interaction really is what helps make these events so successful. And when I couldn't even get to half of our questions, it tells me that you guys were engaged. So we really appreciate it. And thanks to the steering committee for this idea. And thanks again to our panelists. We really appreciate it. So Eric, do we have anything before we wrap up?
We're all good. I think it was a great program. We appreciate everybody. Have a
Yeah, so if you-
fantastic evening.
Yeah, so if you guys need contact information for the speakers, you can find them on LinkedIn. Again, Finley looks a little different, so don't be alarmed when you look at, you know, the clean shaven guy on LinkedIn, but Chris and Zane, you'll recognize their mugs. So thanks a lot, everybody.
Thank you.
You.
Thanks for having us, everyone.